Mr. Mark Selby, how are you, sir?
Mr. Matthew Gordon, doing very, very well, sir.
I am glad to hear it. I'm also glad to hear you're going to be on our sunny shores later this week, and perhaps we'll get to see you live the following week, I suspect. Is that right?
Yes, that is true.
Okay. And you're
little time off and a little work on the continent. So very much looking forward to it.
Good. Okay. It'd be fantastic to see it. Mostly because you're bringing me some of the homegrown maple syrup that you've been talking about all these
most certainly am.
Weeks and months. Good man. Okay. It's going to be a quick one because you've got a car coming to pick you up in a second, and you've got planes to catch in the next couple of days as well. So you've got a lot to get out of the way. Let's talk nickel. What's happening in the world of nickel pricing?
Yeah. So again, the big earthquakes, big aftershocks. The aftershocks, it took a few weeks to get going, but a little surprisingly to me, actually, we've seemed to settle into a range. In terms of LME prices are now, sort of either side of $33,000 a ton or $15 a pound for the other side. The other key thing is you're seeing in a lot of the physically traded commodities, in terms of nickel, pig iron, sulfate, stainless steel, those are trading into a range now. So again, I think the market is, in terms of today's pricing, has settled into a range that seems to make sense. Now, as it settles down, you're going to see more liquidity come back in the market, and as more liquidity comes back into the trading, people are going to get their nerve up again to try and give the market a shove. So in terms of the big pushes, again, we'll still see limit up, limit down days, 100% for sure. I still think Tsingshan, if they're able to, is going to try and talk the market down here at some point. But again, once we get through there, the fact that we've settled out north of $30,000 a ton, which is where I was expecting it to be, for a lot of people, including us, that's nearly double the price that we were using in our feasibility study. So quite happy to see it settle in that range.
Okay, and I just want to check this out because with regards to the LME component, obviously that was a big deal. I mean, have there been any kind of conversations or discussions around perhaps having to do things a different way, or are we now sort of seeing it sort of settle back and it's kind of business as usual?
I think it's settling down, business as usual. I think there's some lawsuits floating around now too. So, there's probably going to be, there will be, discussions underway, but I don't think the LME is going to, want to show that there's some easy fixes. I don't think there's any particular easy fixes, but, if they come out and say, oh, we're going to do this, this, and this, just it feeds the lawsuit that, oh, you should have done that, in advance and not canceled several $1 billion worth of trades. So.
Right. Okay. So interesting times for those guys, and possibly problematic for them. Let's talk a little bit about China and NPI and how that's reacted to obviously what went on previously. Given potentially, you could argue the problem was caused by China.
Oh, Tsingshan, yep. And then, again, in terms of, there's all kinds of theories around LME being owned by, Hong Kong clearing, whether that led to, little team support there. I don't know. We'll see eventually how that comes out. But again, the NPI chain is a whole physically traded market. And so again, is a pretty, where that's traded is a good support, for where the market is. So, ore prices are up over $100 a ton, so that's come through. NPI prices have moved substantially higher. I know they're still trading at a massive discount to the LME price. But again, if you watch if you're a regular viewer of this, you would have known, at the beginning of the year, I had a forecast for most of the first half, a big, discount on NPI for most of the first half of the year, because the bulk of global production is going to be Indonesian nickel pig iron, and it needs to squeeze out some Chinese supply to find a home for it. As well too, the NPI discount I think is going to be impacted because all that Russian cathode that people may not want to use is its really only market is going to be China. So it's going to cause some short-term imbalances as well that, unfortunately, if you're a Chinese nickel pig iron producer, you're going to be taking it in the teeth, for the next 6 months until we sort of get the overall market sort of product mix back into balance.
Okay, but what about, we're also reading about massive COVID lockdowns, Shanghai and other cities. Is that? Well, I've also been reading that some of the industrial companies are getting a little bit creative and building camps for them, so they don't need to leave work. So maybe it's fine, but is it affecting the nickel demand, productivity update? What's going on there?
Yeah, it's definitely impacted sentiment. In terms of physical demand at this point, I don't think, obviously Shanghai region, if no one's at work, they're not going to need the metal that they need. But, China is a huge country. So, again, if New York City's locked down, Los Angeles, is probably, still business as usual. Same thing, you can use a European example. So, I think until you see COVID go absolutely everywhere, then I think, there's not much risk there. And again, remember back to the beginning of the pandemic when we didn't have any vaccines or testing, and things had spread for a few months within China, and China was able to put the genie back in the bottle. I'm not sure whether they'll get the genie back in the bottle, but if I trust any country to actually manage the health crisis in a good, respond to it aggressively, it will be China. So I think any real demand impact will be relatively small and relatively short-lived. And, it'll be, a buying opportunity going forward. There'll be a huge hit to sentiment, but once we get through that, I think, we'll see all of the underlying demand drivers aren't going away anytime soon.
And a little macro commentary from you here on supply chain issues, if you don't mind, because it's been a kind of maelstrom of different catalysts over the last, well, obviously 2 years with COVID, but more recently with the kind of price appreciation, et cetera. And, we've had conversations about, type 1, type 2, MAT being introduced, the whole OEM component in terms of chasing down and securing their own supply chains by doing direct deals, etc. It's kind of crazy. Has it always been a little bit like this, or is this a kind of new paradigm we're in?
Oh no, this is one of those new paradigms. Again, compared in the past to what the emergence of China back in the early 2000s, where again you've got a whole range of views as to whether something's real. How real, can you trust the numbers? Are we really going to be short supply? And again, when you're on a new application, you end up, a lot of times on an S curve of adoption. And when you're on that steep part, 30, 50, 80, 100% growth for multiple years is 100% in line. And so what's been fascinating for me for the last 2 weeks is, there's been another massive shift in sentiment around the supply chain. I think, the Russia-Ukraine situation has obviously, sort of put that more front and center, but there's been a whole series of things that have come out, over the last, few weeks that's, really starting to, I think drive it home. Again, I've been saying if you go back to the first presentation we did in 2019, I said, look we need double the nickel in 2030 that we do in 2020. And there's, outside of Indonesia, there's nothing in the pipeline, and there's not, Indonesia is going to provide a lot more, but there's not nearly enough there. And if you look across the metals, Benchmark had their conference this week and said, look we're going to be way short of lithium, we're going to be way short of cobalt, we're going to be way short of nickel, and we're going to be way short of graphite. And it's not so much that geologically, again, some materials I would argue lithium is not geologically short at all. It's just company investment time to be able to build enough capacity to get there. Daniel Jurgen, who's an oil guy, he's a noted oil and gas guy. The Sierra conference was a few weeks ago, and he's sort of been talking up now for a year the concept of the big shovel. It's going from big oil to big shovel. That there's a huge range of commodities that and I would agree. I think that the current big guys, BHP, Rio Tinto, are too small and too slow to be able to actually deliver the volumes of material that are needed. And we need a Chevron, ExxonMobil, BP, Shell, who are used to doing $20 billion projects, to do a couple $20 billion projects in the mineral space to provide the minerals that we need going forward.
But doesn't this this whole thing's running through all commodities at the moment, where what companies are claiming they're going to be able to do and what they will actually do are miles apart, right? And I guess in a degree, in terms of, I talked about new paradigms, that this bit isn't a new paradigm. There's always been companies that will, who talk a good game and aren't necessarily able to kind of deliver. And whether that be because they're cash constrained, or whether that because they're in the wrong part of the cycle, whether that because technically they're not competent or capable as a management team to do it. There's lots of reasons, but that means the problem doesn't go away. Right, and we've talked about this last week with the former chairman of Cobre, who's saying he perhaps not necessarily a big believer that a lot of the lithium companies are technically competent enough to deliver the lithium they say they're going to. I've had a conversation with the one guy who got into production in the last cycle at Paladin. He's saying technically there's a lot of companies who are not going to be capable of getting enough uranium into the market, certainly not at at all, or at the volumes they say they are. So the mining industry is kind of rife with those sorts of problems. But when you look at the kind of demand curve and you're saying the supply component could fall away, that the gap is much bigger than we all perhaps realize. That's problematic.
Oh, 100% for sure. There's two big issues there that I think are each worth, having a good conversation about. First off is in terms of, actually executing enough supply in the time frame that everybody expects. In nickel, our issue has always been people underestimate the demand forecast. So that, we've got a bunch of supply coming from Indonesia, but they don't recognize that a lot of US and European car companies don't want to depend on Chinese controlled supply in Indonesia for the amount of supply. And again, we need a lot more than what they're forecasting. Today one of the key things structurally you need to look at is, how long it's going to take to close the gap. And then when you close the gap, where's the price going to fall back to? Because it always does. Either the cost curve has to move up, where the price has to come back down to where the cost curve is. And so, again, as investors, if you're a longer term investor looking in a 3, 5, 7 year horizon, you need to be cognizant of that, to be able to make sure you exit properly. So as an example, lithium reminds me very much of nickel back in 2004-5. On paper, there's no shortage of lithium projects. Again, lithium is everywhere. And there was a bunch of lithium, special companies. Again, in the early 2000s, you had Falconbridge and Inco and Western Mining and a bunch of nickel focused companies. And there's a bunch, there's literally, a whole, you could double production based on the amount of pressure acid leach laterite projects that have been sitting on the shelf for quite a while, and people continue to refresh all the time. So, the problem wasn't, and we said this back at that time, it wasn't really a long-term shortage. It was just the fact that even if you started today, you wouldn't actually see any production for 4 or 5 years. So, and all what happened, those projects didn't end up getting built for another couple of years. When it was that time frame, that was the most profitable time frame to be in the nickel business. Then they got started. Then they were using a new technology, which really didn't work out that well. And it took them another 4 to 5 years to ramp up. So the market, was really, really short. And it was, nickel pig iron that came to the rescue. I think in the lithium space, again, you've got a pile of projects that, these guys could be doing. They're getting around to getting them going. But, for a whole range of reasons, it's just taking them a lot longer to get there. And I think you're going to see stuff like DLE and other technologies, because these high prices are going to fund a lot of research and make it really worthwhile for companies to hit it pretty hard. Again, companies like Tsingshan are now in the lithium space looking for opportunities, because again, they see this massive opportunity, and they're actually good at executing projects where most companies in the world are not good at that at all.
True, but they have the technical skills. They also have the balance sheet. But even they are not going to overpay. So I just worry about some of the valuations that have been attributed to some of those companies, whatever the commodity. I'm not pointing at anyone in particular, but obviously, you, me, and lots of people in the industry know and can point at the ones which are overvalued. But Tsingshan isn't going to step up to the plate and overpay, or even deliver what the current market is attributing to some of those projects. And I think that's the problem here. If that's the management team's strategy, good luck. Good luck with that one, because there's gonna be a big discussion whenever the kind of final DFS or their economic study comes out between what they've got and and being able to deliver it technically, and being able to deliver something anywhere near the value of the current valuation of those companies. There's a lot of backfilling needs to be done. And again, that's a problem for supply. It's a problem.
Yeah, no, because what again, in terms of, when you look at the marginal production, the thing that I think is particularly scary in lithium, it's not like, you have some higher cost spodumene that'll come in that'll be, need a higher lithium price to support. So that'll provide, that'll end up in the tail of the cost curve. But there's a lot of technologies that come right into the middle of the cost curve. And so, when supply does get balanced, and it will eventually, it's going to, fall a long way. And so you need to be comfortable as an investor that you've got a good sort of view in terms of what that incremental price is. Back in 2006-07, I made a huge amount of money shorting nickel in 2007 because I had done the work and knew that, the marginal cost of this NPI production at that point in time was $9,000 a ton. And that's where the nickel price, was going to be headed once we finally got back into balance. Now, that imbalance can last 3 or 4 years. That's what we had last time. I think for lithium, that's going to be at least this time. And then I think that's the other major issue is in terms of, junior investing, which is where we're focused on is again, it's great that you've got a great project. And the lack of execution at the big mining company is generally even worse, at a junior mining company perspective. You need to get a feasibility study done, right? You need to get permits, right? You need to get, a construction team together that can actually build it and work with partners who want to work with you, even though your balance sheet might not be as big as the majors. Because again, you need to compete against Anglo and BHP to go get the best engineers to, who want to build your project. And, if you're Johnny Promoter or Susie Promoter, that's going to be pretty hard, even harder to pull off. And again, so if you're owning those names and the cycle's here and they're not able to execute, then you're going to come up big time short. So.
Well, talking of which, you put out some results today. I was kind of surprised. The grades are far exceed anything that you've done before. What's happening there?
Yeah. So again, good projects, always give good results. And so, we were very pleasantly surprised. We talked about that East Zone higher grade core that emerged through the drilling at the end of last year and got a bunch of infill drilling results and we knew they were going to be good based on the way we described them before. But, we hit 0.7% over 64 meter interval, down deep, and then another percent above a decent size interval. We're still early days. This is less than 2 years old. I mean, again, a lot of people haven't, we're on our way to feasibility study, and a lot of people are still working on a resource. And we've been really trying to focus our capital on adding resource tons and not really doing a lot of exploration drilling at this point in time. And so, to me, if we can find it, there's the potential for more of it to show up elsewhere. And so, we were really, really excited to see those numbers come out. And again, now that with this latest capital raise that's closing today, we're going to have the capital to be able to do a little more actual step out drilling and test some geological ideas around there. So, again, very, very excited. And again, the scale of what we have is great. The East Zone was a step down from the main zone. It was 2 little blobs in the PEA, and today it's 2.8 kilometers long. Again, you're not going to find a lot of mineral deposits that are, that have that scale. And nickel sulfide deposits, the East Zone on its own, is a massive nickel sulfide discovery. It just happens to be next to 2 other resources that are there. And we think there's 18 other targets to go after this year.
So do you think that you have, do you think you made the right decision with regards to the strategy in terms of just get to a resource? I know you at the end of this year you're gonna put out the another resource. Is that right? At the end of this year? End of Q2, and then a feasibility by the end of this year. Is that? Do you still feel that's the right strategy?
Oh, 100%. Again, just with the prior conversation, people want supply as soon as possible. There's very few companies that are advancing this project anywhere close to this, and so with the car companies, with the EV supply chain, who need nickel before 2030, if you've got a good shot at actually getting some of that, you're going to be top of the list in terms of who they're talking to. So, So for us, everything we've seen in the market today suggests, that was 100% the right idea. And as well, too, again, going back to 2019, we said by the middle part of this decade, we're going to be in a super cycle, and here we are. So,
tell me what it does for you. Or remind me, well, I know what it does, but remind me,
yeah.
And anyone listening to this, what it does for you, because you've talked about the possible scale of what you've got today, but you also said, well, we've probably got another, we've got another 18 targets, which, it's all fairly homogenous stuff, except that, well, that's why I was kind of surprised by the high grade stuff coming through here. It's fairly homogenous. We can build something of real meaningful, multi-decade, multi-cycle scale here. But getting to a resource now is important because in terms of something that could get into production, something that could be feeding, ore into a processing plant, and then continuing to build out the other things. You're probably not the guys that are going to do that, but you need to demonstrate to one audience, which is we can get into production really quickly, and we've got this massive scale of opportunity over here on the side too. I mean, what's that kind of balance that you're trying to deliver into market and for the different audiences that you need to talk to?
Yeah. So again, in terms of for the end consumer, that rapid execution, and again, we already with the main zone, the PEA, we're the largest base metal mine in Canada when we're fully ramped up. So, to wait another year and a half to drill even more resource to be, that much, once you're number one, it doesn't make sense to go much further than that. Then, in terms of the story, from an investor perspective, again, that middle part from PEA to feasibility study there's not a lot of, exciting news. I mean, that to me, that was what was great about this result is we're still delivering, some real upsides in terms of what we're doing in what's largely an infill drilling program. But the second part is, again, starting to really step out with the exploration potential because one, it's good news flow for investors, and two, when a bidder emerges, again, when you look at base metal assets, good projects go for 0.8 to 1 times now. Good projects with great exploration potential, you can trade up to 1.2 to 1.5 times now. So we think it's a good use of capital right now to help demonstrate what that exploration potential. I'm not going to blow my brains out drilling the 4th or 5th or 6th billion ton of resource right now, but highlighting that there could be good potential to hit those kind of numbers. We think it's a very, very good use of capital at this point in time.
Okay, and you just raised some capital. Is that closed yet?
It's closing in the next 24 hours. So.
Okay, fine. And then I guess you will be talking to the market about two things. One, why you took money in that shape and form when you said you were going to get a strategic partner on board, and two, what you're going to be doing with that money.
Yeah. So again, advancing the feasibility, stepping up the exploration potential. In terms of strategic partner, I know talked quite a bit about it through the end of last year and into this year, and we were in discussions. Again, one group pulled out for reasons on their side. That we had a high degree of confidence that we're going to be there. But at the end of the day, the strategic partner was a means to an end. We wanted to be able to give institutions confidence to be able to step up and buy the story, because it's the other institutions, not the strategic, who are going to be in the market buying your stock on a regular basis. And so, the fact with what happened in the nickel market, convince people the market needs the project. Two, that nickel prices are going to be a lot higher for longer, allowed us to get 25 plus institutions into the deal. So, we were very, very happy with where that landed. And again, that's what we wanted to get. And we didn't have to give up a 10% seat at the table to get there.
Okay. Yeah. Okay. Like I say, means to an end, and you're not going to be able to get on and do what you want to do. So we'll kind of look out for a little bit more detail once you're kind of able to shed some light on the exploration, because like I say, that's super, super interesting, but not get distracted enough that you aren't able to deliver a feasibility study at the end of this year. So that's what we're all looking towards. Mark, I think we've got to wrap it up there. You've got a car waiting for you.
I most certainly do. All right. Thanks, Matthew. Take care.